Today I'm going to break down the exact model I use to trade the markets. My model prioritizes high confluence pullbacks into key levels to reduce drawdown and improve risk to reward, rather than anticipating moves early. I use AMD, IFVGs, order blocks, CISDs. It just all depends on the context of the situation. Before we start, what is a continuation trade? A continuation trade is after a key level is hit, instead of taking reversals out of the key level, you wait for a clear displacement showing some reaction out of the key level, and from there you wait for a retracement, usually a 5-minute or a 15-minute unfilled fair value gap, inside of that trading leg that is reversing out of the key level. Why continuation trades are important is because we are not catching a falling knife like in reversal trade, and instead you get extra confirmation and displacement already, making it a lot higher confluence. What I trade is like many other IFVG traders out there like Blake, Ronan, and many others. I wait for the highest time frame inversion of the current trading leg. Make sure it isn't a random inversion, but is an inversion coming from a key level. Also considered a sponsored fair value gap when it is coming from a continuation trade. I trade all the way from the 30-second time frame all the way to the 5-minute. So if we have like a trading leg and it has like a 1-minute gap, but there's also a 2-minute and a 3-minute gap, I have to wait for the 3-minute gap to get inversed before I can consider entering. A key thing for me is I look for accumulation before any sponsored gap is hit. So because I work with AMD, I'm always looking for accumulation, manipulation, and distribution. So a lot of the time, I want accumulation, which creates low resistance liquidity right before any sponsored gap is hit, either that 5-minute gap, 15-minute gap, or even sometimes there'll be some like rejection blocks. The reason I wait for this accumulation to form before I want these sponsored gaps to be hit is because I do not want a bare minimum inversion entry as my entry, because I want my entry to have more context around it than a random inversion right after some sort of key level is hit. So because we accumulate before we manipulate into a key level, like these sponsored fair value gaps, we create more context as we have low resistance liquidity that basically gives more areas for us to target, so that it becomes a more high quality setup overall. Now for the model. So for the model, I would stick to mainly focusing on 3-minute to 5-minute inversions only. So basically how it works is these higher time frame inversions like the 3-minute, the 4-minute, and the 5-minute contain imbalances inside these legs, because they're usually not just like a stronger move because they're a higher time frame inversion. Like if we have a 5-minute inversion, you'll have a bunch of 1-minute gaps inside of there, or a 1-minute order block inside of there, or anything like that. So a lot of the time is when a 5-minute inversion is created, or a 4-minute or a 3-minute, or any of these high time frame inversions, you expect some form of like retracement into these smaller gaps before we continue higher. So instead of like saying through unnecessary drawdown, you basically wait for the lower time frame to have its move, and through there it basically confirms your bias because of the fact that the lower time frame gap holds, or order block, or whatever it is. And then from there, it basically gives you a better entry overall as well. So the goal of this model, with trading the inverse on these higher time frame gaps, I usually see lower RR, as a lot of the time is we have to put our stop loss at the swing low or swing high of that trading leg, as a lot of the time is you can expect a retrace and you don't want to get stopped out when you could still be in that trade. So what this model does is when we're trading the retrace entry instead, we basically wait for that key level inside the retrace to happen, and from there we wait for some confirmation and we enter. And instead of having to put it at the swing low or swing high, there's no reason for that, because we have the higher time frame gap holding and then the lower time frame gap doing its job as well. There should be no need for that higher time frame swings point to be hit anymore. There should be no reason for a resweep. So there's no reason for that unnecessary drawdown down there. Instead, we just can have a tighter stop, which can give us higher RR overall, and that is the main reason for that model. So the first way that you can play this is you can limit order at the lower time frame imbalance, as we expect it to hold since the higher time frame gap already inversed. With this, you get a slightly better RR, but the risk is slightly higher, as it may retrace deeply into the expected area and may retrace even deeper or just fail altogether. So that's why sometimes I don't prefer that option unless I have a super high conviction on a trade and want to get the best RR possible. The second way is what I recommend is we wait for the key level to get hit inside these higher time frame gaps, and from there we wait for a lower time frame CISD, inverse fair value gap, or just some form of rejection wick giving confirmation that that level is holding. This is my preferred option as RR is still good as I put the stop loss at the swing instead of the fair value gap low or high. So it's just at the swing low of that current retrace. And from there, I don't expect us to go any lower. And we have more confirmation as we rejected from the key level. And usually when you do this, you guarantee almost no drawdown if it's going to be a winning trade. That's it for the model. Look at it for yourself, back test it, look at it, forward test it, whatever you need to do. I wouldn't just put it into your way of trading. I am just trying to show this to a lot of IFVG traders, as this is not the most beginner trading strategy, as you need to have a good idea of how the market works. It's a lot of more discretionary in this way. So if I were you, I would just mainly look at this, back test it, not really put it into your strategy. Don't put live actual funds onto this yet. Back test it for yourself, and then once you see results from it, actually execute it. And then if it works for you, just that's amazing. And then, if you want to see some like actual chart examples of this, comment down below. Just let me know.